UGI continues to rage towards its 52-week low with a yield of nearly 7%. Is now the perfect time to add UGI to your portfolio to see the share price double or even triple, as well as that yield on cost grow to double digits. In today's episode, we are going to continue to look at their earnings to see how their latest report is on the top line revenue as well as their bottom line net income growth. We're going to take a look at the health of the company's balance sheet, their total cash versus their total debt. And as always, we will see how some of their competitors in the gas utilities industry has done on a total return basis over the last 5 years. And we want to have a quick look at the institutions, whether they are buying or selling UGI Corporation. And as always, we will touch upon that dividend safety, which has dropped to 60, and look at some financial metrics which are important to this company. And we'll also briefly touch upon their buyout of AmeriGas from 2019. And we will put them through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that investor margin of safety. Now, as we can see, year to date, it has been hammered horrifically down 42%, as much of the industry right there at the 52-week low, although it does offer investors an appetizing 6.8% starting yield. Now, investors who have been holding the company over the last 10 years would be essentially right at the lowest point that it's traded at this period, down 18%. And we do see its highs around the end of 2018 at around $60, so 3 times higher than the current trading price. So let's dive into this company and see whether or not this is one to add. Now, top line revenue, what we like to see, 3 to 7% growth year on year. September 2019, 7.3 billion on the top line. 5 years later, so their latest annual report, 8.9 billion. Now, this has increased, which is positive to see over the last 5 years. But we can see, and you can argue, the cyclicality of the industry, a decrease to 2020 before an increase to 2022, and then a decrease to 23. And we'll touch upon this when we look at the financial metrics 10 years percentage form. Now, bottom line, a similar story, or is it slightly different? Or 256 million reported of net income in 2019, a loss of 1.5 billion in 2023. Now, it's not been great when you consider that it went up from 2019, 256 million to around 1.5 billion in 2021 before lagging down to 1.1 billion in 22 and then a net loss in 2023. Now, we'll touch upon shortly the earnings to explain some of these movements, but before we do that, let's jump straight into the balance sheet. Now, total cash versus total debt, 447 million in 2019. Latest report, 260 million. So they are holding slightly less cash than they did 5 years ago. And in comparison to their total debt, what we see here is from 6.6 billion, it has increased very slightly to around 7.1 billion. And this we will take a look at when we look at that all-important dividend safety. Now, in terms of how it performs versus some of their competitors in the gas utilities against companies like National Fuel Gas and Brookfield Infrastructure, what we can see on a year-to-date total return, so includes those dividends reinvested, they are down 40%. Now, that is the worst performing of their peers. And when we extend that to 5 years for UGI Corporation analysis, what we can see, again, the worst performing, down 53%. So again, something to bear in mind. Whilst past performance isn't indicative of the future, it is worth just having as one layer of research. Now, institutional ownership does sit around 81.53%, around 858 million worth of shares sold from the institution over the last 12 months. And over the last 12 months, the same period, around 1.16 billion. So slightly more buying by the institutions of UGI than selling. And do bear in mind, when the institutions believe that a recession is coming, they will tend to sell the majority of their stocks in tech plays and move them into what they believe safer recession-proof stocks like utility companies. And we can see over the last quarter, so Q3, slightly more buying with green depicting inflows and red outflows. But as always, we don't copy what institutions do, and we do need to do our own due diligence. Now, when we take a quick look at their earnings for Q3 versus Q3 2022, we can see that their top line was down 27.4%, their bottom line down 46.31%, earnings per share also down, as well as both their net profit margin and their operating income. Now, we can take a look at a few reasons for this and look at their earnings versus Wall Street estimates. And when we take a look, what we can see for UGI, the headline states Q4 earnings beat estimates, whereas their revenues lag. So we can see they reported their fourth quarter fiscal 2023 3 cents per share, which was expected to be a loss of 6 cents. So that was a positive beat. And we can see a year ago for the same quarter, they did essentially have break even. So not only did they beat the Wall Street target, but they also beat the year-on-year movement. Now, in terms of their revenues, well, we can see revenues of 1.4 billion. It did miss the analyst estimates quite considerably of around 2 billion by 30.4%. And also on top of that, as we mentioned, their top line declined by around 27% from the last year's quarter. So some mixed thoughts there. Whilst they did beat the earnings per share, their top line, they did drop, which isn't really great. You do want to see at least continued increase on the top line by at least the inflation of around 3 to 4%. And when we take a quick look at AmeriGas Propane, which for those who don't know, they did buy the rest of their shares for 2.44 billion. They did previously prior to 2019 hold around 25%, and they bought the remaining 75%. So in terms of how that has performed, that particular sector, they had revenues of around 434 million, again down 16.5% from a year ago the same quarter, as well as that retail gallons sold during the quarter declining 7% year on year. The reasons for this they attributed to customer attrition, structural conversion, and continued storage of drivers. So something just to bear in mind there, this isn't a company that right now has strong year on year growth, but it is also to be expected given that the company's share price is down around 42% year to date. Now, when we do take a quick look at their earnings in detail from their own site, we can in fact see that the utilities was essentially the only revenue stream that did increase from 2023 12 months ended to 2022, with essentially AmeriGas Propane down from 2.9 billion to 2.5 billion. Now, in terms of the dividend safety, we have a score of 60, making it borderline safe, and a market cap of 4.62 billion, so it is a mid-cap company. Now, previously, when we did review this on the channel, it was around 70, so it was safe. However, not too long ago, in fact, just a few days ago, it was put down to 60, borderline safe. And if we do take a very quick look, we can see a few of the reasons why this has happened and this change has been performed. Now, one of the particular reasons for this, from a press release a few months ago from the company, they did essentially say that embedded within their review, there will be actions to optimize the company's cost structure and realign its capital allocation priorities. And essentially from this information, what was understood when we take a look is that they are looking to potentially have a sale or a spin-off of the propane division. And the reason why this is a worry to that dividend safety is that it is already at the upper end of 45% in terms of their payout, which is UGI's target. And given the divestiture of UGI's propane segment, it could elevate this to around 70% or higher. And we will touch upon these figures now. So let's take a look and understand exactly how this will affect that company and the dividend metrics. So firstly, let's start off with the key essential recessionary metrics. Well, 0709, they in fact increased their dividend. Negative 16% sales, which was the average growth of companies in the S&P 500. And they did not do that bad at all. A negative 16% versus the S&P's negative 55% return. So not bad metrics for those that do see a recession inbound. 4.2% increase in May 23, which for me is fairly positive, as you are locking in a fairly high yield currently of 6.8% and getting an increase in line with inflation. Last 5 years, even better at 8%, and last 20 years, 7%, which I would say is fairly strong. When you couple that with the fact they are a dividend aristocrat, having paying increasing dividends over the last 25 years or more, and essentially paying dividends for the last 139 years without a reduction, a phenomenal achievement and not something that a lot of companies have done. Now, dividend yield theory states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, bearing in mind we're not looking at any model in isolation. Forward PE, again below the 5-year average, another sign of undervaluation. And we see the sector PE significantly higher at 15.6. Now, yes, it is trading at its 52 or towards its 52-week low, but remember that isn't a sign of undervaluation. Likewise, 52-week high is neither a sign of overvaluation. Now, typically we prefer the free cash flow as earnings is susceptible to manipulation by management through accounting, but for utilities, a lot more volatile, so we do ignore the free cash flow. So below 75% is what we like to see for utilities. Bear in mind from what we just read, UGI are typically aiming for around 45% as the upper end of what they like the payout to be. And we can see it has been roughly around that with around 50 to the high 40s over the last few years. But so far from what we can see, this dividend does seem to be safe. Earnings per share, 192 in 2014, 284 in 2023. Nice growth for a utilities company. We can see some inconsistency, some increases, some decreases. But again, bear in mind, this is the cyclical nature of the industry. And we can see that even more evidence with the sales growth, where we see some nice double-digit increase followed by double-digit negative growth, and so on and so on. The cycle recycles. Now, total sales, what this essentially translates to numerically, 8.3 billion in 2014, 8.93 in 2023. So not much movement over the last 10 years, even with that AmeriGas propane business, but you do still see again that cyclicality right there at the front. Shares outstanding, very typical as we mentioned on the channel with the utilities industry. They do rely on issuing equity to fund a portion of their growth expenditures. So do expect the utility companies to dilute your position as a shareholder. Now ROIC, 10% or more is what I personally like. It gives me faith management are able to effectively allocate their capital. But with the utilities, we can drop that to around 7.5%. And we can see for the large part, it has been around there above. But given that net loss in 2023, we do see that negative percentage here. Now margins, operating margin, again, we do see that drop due to the net loss of 2023. But before that, we do see it around that 18% that we ideally like to target for the utilities industry. And finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. 5.5 is the maximum for utilities. This signals the number of years it would take the company to pay off all of their debt net of cash on hand. So 4.06, it is below the 5.5, and 2024 expected to come down even lower to 3.86. So we can see right now why effectively that dividend safety is sitting at 60. And personally, I do believe it to be safe for UGI Corporation. Now, as always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And remember, if you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio, or essentially run through these models again to get to the acceptable buy price, then do click on that pinned comment below. So jumping into the first model, which is Graham's valuation, we have the stock ticker UGI. Now, earnings per share, this is for 2022. There is a side note here. The trailing 12 months is negative 7.16, so it is something just to be aware of for an assumption and judgment we have used in our model. Growth rate at 3 with the yield on AAA corporate bonds at 5.06. Bearing in mind the higher the yield, the lower the intrinsic value. So Graham's model comes to $43.22. Essentially right there at that 52-week low, around double the upside or 100% upside to the current trading price. But remember, we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have the second model, which is the multiples valuation model, companies in a similar sector and size. We have Northwest Natural Holdings, Atmos Energy, New Jersey, and NI Source. We have their stock price, earnings per share, P multiple, and we get the average multiplied out by the earnings per share to give a UGI stock price of $79. So when we take a look at that, we can see that is well above the current trading price and above the 52-week high. However, given these companies, I don't believe you can compare them to UGI with their forecast moving forwards and their projections. I don't believe we will include this multiples valuation for the output and the intrinsic value calculation. So we move to the dividend discount model, the second model we're using, where we have the yearly dividends. Some nice growth rates over the period with an average of 8%. Now, forward looking, I've gone slightly lower than what we've seen over the last 3 years at 3.75%. Remember, if you do grab a copy of the model, you can play around with these numbers based on your own investment thesis. Now, DDM price of $37, we can see some nice upside to the current trading price, but lower than the 52-week high, again showing signs of undervaluation. Finally, we move on to the discounted cash flow model with our free cash flows year on year. Average growth rate at 5.8%. I have gone slightly lower and lower than analyst estimates. With our discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $36. Again, some very strong upside to the current trading price, but below that 52-week high. Now, the intrinsic value, don't forget, is just the average of these three models that we've run through on today's episode. And as always, if you do enjoy the content, value is being provided, do smash that like button and hit the subscribe so you are continually notified of these videos as they drop. Now, margin of safety, we start off with 10% regularly on the channel if we believe the company has a wide moat, strong financial metrics, good forward-looking data. So it would be a buy up to $35 if you believe so. At 20%, it would be a buy up to $31. At 30%, a buy up to $27. And at 40%, a buy up to $23. If we push that to 45, we can see then you are roughly getting a margin of safety of between 40 to 45% on the current trading price. And I would argue we have used some conservative estimates in our analysis. Now, Wall Street, what do they forecast? Well, they do believe the share price to go up to around $30, so they do believe there to be around 50% upside over the next 12 months. So based on our estimates and judgments, you are looking at a rough margin of safety of 40%, with per Wall Street around 40 to 50% upside. As always, though, let me know your thoughts in the comments below. Is UGI a company you're investing with that very nice yield, or are you looking to sell or have sold over the last 12 months? As always, if you do enjoy the content, do hit that like button. It really helps the channel grow, pushes the content out. Do hit the subscribe and bell if you want to be continually notified of these videos as they drop. And finally, if you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio to get your own acceptable buy price, then do click on that pinned comment. As always, have a great day. Catch you on the next episode and take care.